Everyone thinks the bull run's over after that brutal crash, but the data says something else. In just one night, we saw over $19 billion in crypto positions wiped out, the biggest liquidation event in market history. The trigger? Trump's surprise 100% tariffs on Chinese tech exports and Beijing's retaliation threatening rare earth restrictions. That single policy crossfire sent risk assets into panic mode, and Bitcoin took the hit first. Prices collapsed from above $125,000 down to nearly $102,000 in hours. Leverage evaporated, liquidations stacked up, and traders screamed, "That's it, the bull run's dead." But here's what they're missing. Every historic Bitcoin rally has had a moment like this. A violent reset right before the real expansion. So let's break this down. What really caused the crash, what the data says now, and whether this is the end or just the beginning of the next leg. The shock event. Trump's tariff escalation caught everyone off guard. A 100% tax on Chinese tech imports, semiconductors, AI chips, robotics. China instantly fired back, restricting exports of rare earth minerals that the US supply chain desperately depends on. It was the perfect storm. Global trade tension, fear, and over-leveraged markets. Within hours, 1.6 million traders were liquidated. Crypto futures exchanges bled billions, and every retail investor who bought the breakout at $125,000 got crushed. But under all that blood, something important happened. Bitcoin's structure didn't break. The hidden strength. Despite the meltdown, long-term metrics still flash green. The amount of Bitcoin sitting on centralized exchanges has fallen to 2.8 million. The lowest since 2019. That means fewer coins are ready to sell. The supply crunch is tightening. Meanwhile, 64% of all Bitcoin hasn't moved in over a year. That's not retail panic, that's conviction. In 2017, that number was just 40%. In 2021, it was 53%. Now 64%. The veterans aren't selling. Even the MVRV-Z score, one of the best cycle top indicators, is far below the danger zone. Translation: we're not even close to euphoric territory yet. So yeah, the market looked dead short-term, but structurally, it's still bullish. Institutional view. What big money sees. Wall Street hasn't flinched. ETF inflows continue, even after the crash. BlackRock's Bitcoin Trust added nearly $400 million in the same week the market dropped. Standard Chartered still sees $200,000 by year-end 2025. JP Morgan's volatility-adjusted gold model points to $165,000. And VanEck and Bitwise are still in the $180K to $200K range. Their logic? ETF adoption has broken the old 4-year retail cycle. We're now in the institutional liquidity era, where short-term volatility is just noise inside a much larger structural uptrend. Technical picture: before the crash, RSI was overheated above 70, classic overbought signal. MACD showed momentum fading. The sell-off was overdue. But look what followed. Rapid stabilization between $110,000 and $118,000, not a collapse to $80,000 or $60,000. That's how strong hands behave. Whales and funds bought the dip while everyone else panicked. The base held firm, and that's usually the first sign of a market resetting, not dying. The risks still ahead. Let's be real, it's not all sunshine. 3 things could still wreck the setup. At the Fed, if inflation spikes and rate cut expectations disappear, Bitcoin could take another leg down. A leverage. Futures open interest still sits around $80 billion. That's dangerous. One wrong move, and we could see another liquidation spiral. Geopolitics. If the US-China conflict escalates beyond trade, sanctions, cyber war, or South China Sea tensions, capital could flee to bonds and gold. Short-term pain is still on the table, but structurally, the bull case remains stronger than it looks on price charts. The bottom line: this wasn't the end of the bull run. It was a purge, a brutal one, yes, but necessary. Weak hands flushed out, leverage reset, liquidity rebuilt. Bitcoin's fundamentals remain ironclad. Exchange balances low, long-term holders steady, institutional flows unshaken. If history rhymes, this correction is the mid-cycle shakeout before the final mania phase, not the top. We may look back and realize that the $104,000 panic was the best buying window of the year. So before you call it over, check the data, not the headlines. Because the cycle's not finished, it's just reloading.